Oliver, a nice pile of cash is going to hit my personal account here in the next few days after Verizon, the Verizon deal is closed at Vodafone. I need another dividend play. I'm thinking HSBC. What do you think?
Could be a nice one to invest in if you're after a nice dividend yield. HSBC yields 5% at the moment, which is quite a decent amount for a big, stable institution such as HSBC. It's got a solid capital position. It can keep paying its dividend. You'll get your 5% out of it.
Did the results didn't look all that stable that we saw today, though, right?
No.
I'm a little worried that I'm getting more emerging market exposure than my personal account can handle here at present. I am just a journalist, you know.
You are getting plenty of emerging markets exposure with HSBC. About 70% of its profits come from either Hong Kong or the rest of Asia, so lots of emerging markets. And that's what's pulled the share price down over the past year. The shares are down about 14%, which is underperforming the FTSE 100 and UK banks. Now, you might say that's unfair to HSBC because it has more in common with Asian banks, but it's slightly underperformed the Asian banks as well. So it's not been great from that point of view. And again, as I say today, the shares haven't done well. They're down about 4% today. The earnings, the results missed expectations.
So I guess there's a deeper question too, right? Some number of years ago, pre-2007, say, I might have thought a big global bank is a good income stock, right? And whether HSBC is that today, whatever its capitalization ratios might be, first I have to worry about emerging market exposure and the accompanying volatility. Then I just got to worry, do I want to own any bank as an income stock at this point? Is that the whole class too volatile to play that kind of role in a portfolio?
Well, the banks would like to see themselves as income stocks. I think particularly in Europe and to an extent in the US, they've kind of accepted they are not growth plays anymore. As in their main markets, there's no growth. So they want to get to a position where people can rely on them as income stocks again. And they say they've taken a lot of risk out. It's going to be much more secure, etc. But there's still an awful lot of uncertainty around the whole sector. A lot of it's around regulation. How much capital will regulators finally require? The requirements keep going up and up. And will they be able to sustainably generate the kind of profits that would allow them to pay a decent dividend and give investors a good yield? I think the jury's still out on that one.
So do you have a sense? Do we know the answer to this puzzle a year from now, 2 years from now, 5? Or is these kind of regulatory uncertainties you've just highlighted indefinite as far as investors can tell at this point?
Well, it's hard to know when the regulatory uncertainty will disappear. I think it's going to carry on for the next few years. In the meantime, if you were after a yield from the banking sector, there are probably worse places to look than HSBC. But to say that it's a high yield in the sector, I think it's still too early for that.
Thanks.